What's up, guys? I'm Jeff Montgomery and welcome to Tax Planning on the Whiteboard. Today we're going to talk about the methods of transferring retirement accounts from one custodian to another, more specifically indirect versus direct money transfers. Sounds pretty simple, doesn't it? Well, generally it is, but if done incorrectly, the IRS is waiting for you, setting all sorts of tax traps along the way. Quick disclaimer. This is not specific information to anyone watching the video. Please don't implement any strategies you see or hear on this video without talking to your financial professional first. Now that we got that out of the way, let's go to the whiteboard. Okay, on our whiteboard presentation today, there are two types of transfers from retirement accounts. And we're going to highlight those as direct transfers, number one, and indirect transfers, number two. Now, today's show, we are going to talk more about indirect transfers, and we'll save part two of this episode for a discussion on direct transfers, which is the main way that we would recommend any transfers take place from retirement accounts. But today, we are going to talk about indirect money transfers. Okay, so when we're talking about indirect money transfers, we're really talking about what is commonly called a rollover. And a lot of people will use the term rollover and transfer as the same term. And technically, they really are not the same term, because when you do an indirect rollover of a retirement account, you are actually acting as the middleman yourself. So you are going to take custody of the money. So we're going to write down here, custody of the money, where you are going to take custody of the money. In a way, you're acting as the middleman in receiving these funds. Now, we're going to make a distinction in a second about the difference between, let's just use a popular employer-sponsored plan like a 401k versus a traditional IRA or even a SEP or a simple IRA. Okay, so we'll make a distinction there in a second. So the first one, let's just talk about transferring funds from one IRA custodian to another IRA custodian in the indirect transfer method. So technically what you're actually doing here, when you do it indirectly, you are receiving those funds from the account. Now you have 60 days from receipt of those funds to put those funds back into a new IRA account, okay, new IRA. And you may have done this transfer for a number of different reasons, or rollover for a number of different reasons, such as just choosing a different custodian, a different investment manager, different investment opportunities. A variety of reasons you could have done this in a 60-day rollover. But keep in mind, you have 60 days from receipt of those funds to put it into the new IRA. Now, when does that 60-day clock begin? Well, it actually begins when you have receipt of the money. And this is an interesting little tidbit here. When a custodian issues you a check, and by the way, if you're doing an indirect rollover, the check is going to be written in your name. And it's going to come to you if it's a paper check. Of course, there could be a direct deposit situation. Let's take that off the board. But it's going to come to you. And what if it sits in the mailbox for 2 weeks before you actually pick up that check? When does the IRS consider that you actually have receipt? This is a bit of a gray area. It's not when the money left the account. It's not when the custodian issued the check. It's when you have receipt of that check. So therefore, you're going to go and you're going to deposit that check. Now, you have 60 days, and it has to be within that 60 days. It can't be the day after the 60-day time period. So within that 60 days, that money has to be into the new account, the new IRA account, in order for it to be called a successful indirect rollover, okay? We mentioned this before. You can do one indirect rollover per 365 days. That's not a calendar year. It's per 365 days. Now, what if this was money coming from a 401k? So let's just say we have a 401k and we are going to do an indirect rollover of a 401k. Now, one thing that's interesting here is that we highly do not recommend this route. By the way, guys, 60 days, it sounds like a long time. Something could happen. Something could get in the way, life gets in the way, and all of a sudden, you have not put that money into the new IRA account at this time. But something's even more interesting when we're talking about a 401k and we're doing an indirect rollover. The employer is required, and this is an IRS rule, they are required to withhold, okay, a mandatory 20% from those proceeds. And that 20% they are going to send to the IRS. So they're going to withhold 20% before it gets to you. Now, all of a sudden, you're going to have 20% less because the employer withheld that 20%, sent it directly to the IRS, and now you have to put that money into an IRA, okay, IRA account, again, within that 60-day time period. Well, guess what? You don't have the full amount that you withdrew because the employer withheld 20%. So a perfect example of this, what if you had $100,000 sitting in a 401k, you did an indirect rollover into an IRA, so you took receipt of those 401k funds, so you received $80,000 because they withheld 20%, and you go ahead and put that $80,000 into the IRA. Well, it sounds like, okay, you did a successful indirect rollover. Actually, you did not because you took out $100,000 for this rollover. The employer withheld $20,000 of it. You have to make up that difference from other funds from somewhere else in order to do a successful 60-day rollover for the full amount. You have to get $100,000 in there. Well, what if you don't have $20,000 sitting in your checking account or some other account where you can make up that difference? Guess what? That $20,000, that 20% withholding in this example is going to be taxable. And I'm going to throw in another little monkey wrench here. Another little tax trap is not only is that withholding now considered taxable, if you're under 59.5, it could be an additional 10% penalty on top of the taxes. Now, again, the employer sent the money directly to the IRS. If you do this successfully and you did have the extra money laying around that you can put into the newly established IRA account and you did a successful full 60-day rollover on that full $100,000 in this example, you will get a tax refund, again, because the employer withheld the 20, you will get that refund back when you file taxes the following year. So keep that in mind. But again, you have to have those proceeds laying around somewhere else in order to do this successfully. So interesting little tidbit there, interesting little tax trap when you do an indirect rollover. And this is one of the reasons, there's multiple reasons, but this is one of the reasons that we really don't recommend the indirect route. On next week's episode, when we talk about part 2 of our transferring from retirement accounts, we're going to get more specific and we're going to talk about direct transfers, a much better way to go than the indirect route. This has been Jeff Montgomery for Tax Planning on the Whiteboard. If you like what you hear, hit that subscribe button and we'll see you next time.